Global investors are holding their breath ahead of the US CPI print due today. A second month of blip in US disinflation could pour some cold water on Federal Reserve's rate cut expectations, and that could trigger profit taking in a wide range of risky and less risky assets. So, welcome. This is Swissquote's Daily Market Talk. So this week started with limited risk appetite in US stocks and a fresh record for Bitcoin. So major US indices were mostly flat on Monday's trading session. The S&P 500 slid 0.11% yesterday as sentiment in technology stocks was, quite mixed. Nvidia, for example, tumbled 2% yesterday, but Google gained nearly 2%. The US dollar recovered the post-US jobs data losses as the US two-year yield stabilized near a touch above the 4.5% level and the US 10-year yield near the 4% psychological mark ahead of today's all-important US CPI data. Now, the market is not feeling fully comfortable into today's inflation print because, there are several factors out there warning that we could see a second blip in monthly inflation or disinflation in the US that could eventually lead to a further softening in dovish Federal Reserve expectations. And one of them is, the jump that we saw in gasoline prices in February in the US. Another one is the change in CPI calculation, which is now thought to spit higher inflation numbers than otherwise for a few months in the US. And a third one is these rising inflation expectations. Because released yesterday, the New York Fed's survey showed a steep rise in 3- and 5-year inflation expectations for the US and a steady expectation of around 3% inflation for this year. So that basically means that the consumers in the US who have been surveyed by the New York Fed, don't expect inflation to ease much further from the actual levels this year. And, that's actually a problem because inflation tends to be self-fulfilling because if people think that prices won't ease, they will also ask for a higher pay to cope with price increases, and the higher wages are obviously reflected in higher consumer good prices because obviously companies out there should increase the prices of their products and services to cope on their end with higher wages, and higher consumer good prices make people want to earn more, and it just goes on and on like this, a vicious circle. So anyway, we will see what the inflation data tells today, but the headline inflation in the US is expected to have steadied at 3.1% level. Core inflation is expected to have eased from 3.9 to 3.7%, both on a yearly basis, but monthly headline inflation figure could actually pose a problem because it's expected to have grown faster in the month of February. So our data sets in line with expectations or ideally lower, softer than expected should reinforce the Fed rate cut expectations for June, pull the US yields and the US dollar lower, whereas a higher than expected set of inflation data from the US today should soften the Fed dose hand and trigger a sell-off in US Treasuries, hence a rebound in US yields and the US dollar. So I think that there is a chance that, we might see a bad surprise from today's inflation numbers in the US than otherwise. For equities, the expectations are mixed. We know that volatility will certainly be on the menu of the day as Federal Reserve's data-dependent approach nowadays results in an increased focus on the inflation data, and Bloomberg data shows that over the past 6 months, the S&P 500 moved 0.8% up or down on average after the release of CPI data in the US. And this number will likely go up in the run-up to the first interest rate cut from the Fed. So we don't know where the market will go today, but we guess that, there will be some decent volatility and interesting price action following the US inflation data that is due later today. In the meantime, Germany will release its own inflation numbers today, which should print a softer yearly and a higher monthly figure. So the euro-dollar retreated from the post-NFP peak at yesterday's trading session on expectation that the European Central Bank will cut more than the Fed will this year due to obviously a softer economic outlook in the Eurozone and a fading pressure on wages in the Eurozone as well. While Japanese yen traders are busy gathering evidence to justify a rate hike in Japan in the next few months. Yesterday, the BOJ didn't intervene to slow the bleeding while Topix index fell more than 2% just in one session. So that has been perceived by traders as a sign that the Bank of Japan is finally preparing to exit its ultra-loose monetary policy. And this morning, the PPI data from Japan came in higher than expected to support the expectation that the Bank of Japan shall move maybe in March, maybe in April, but more probably in April than in March, in my opinion. But note that still, it's not a one game because the dollar yen is higher this morning as Bank of Japan Governor Ueda killed the bull's joy yet again, saying that the Japanese economy is recovering moderately, but that there were some weaknesses seen in the recent economic data, which I personally interpret as, you know what, forget about your March rate hike from the Bank of Japan. Elsewhere, well, as I was saying at the very beginning of this episode, well, Bitcoin hit a fresh record at yesterday's trading session, a coin traded at $72,000 level. The massive inflows that have been allowed by the introduction of spot ETFs earlier this year, which already amassed near $10 billion worth of inflows, and upcoming halving in Bitcoin are fueling the actual rally that we see in Bitcoin prices. The bulls are obviously eyeing the $100,000 psychological mark, and I believe that we will get there. But what will happen after is yet to be seen, because Bitcoin rallies on classical demand supply dynamics today, but the use cases of Bitcoin and cryptocurrencies are not following the same move. So during the latest rally, we would at least talk about the Web3, the DeFi, and all of those fundamental developments that we might see and that would make these cryptocurrencies the future of finance. But today, we talk about flows only. But flows point at higher Bitcoin, and that actually does offer Bitcoin a good diversification excuse because, well, the coin is at least moving on its own fundamentals today and not on, well, traditional market news. So the CPI print from the US today will certainly not derail the rally, although the exponential rise in the Bitcoin price that we see today, well, kind of whispers that correction will kick in one day, but that day is not necessarily, well, tomorrow. So that's good news. That's a good diversification opportunity for those who are looking for it. But it's risky. And if you like risky bets, well, you may also have heard of T-Rex and Granite shares 2 times long NVIDIA daily ETFs. So the latter saw its second highest trading volumes yesterday, apparently, amassing a record $252 million worth in fresh capital. And as their name suggests, well, these ETFs give investors the double of NVIDIA's daily returns. And so, well, it's not surprising that Granite shares double those NVIDIA ETF is up by more than 250% this year. And that's way more than Bitcoin's 70 and something percent rise during the same period. To say that, well, don't worry if you missed the Bitcoin train, because you have some great opportunities out there if, of course, you love taking risk. And well, if you don't worry, because your good old gold is also consolidating gains near record high levels. Now, any rebound in the US heels on a potential CPI disappointment later today could actually trigger some profit taking and a price pullback at the current overbought market levels in gold. But on the other hand, softer yields on a soothing CPI data could encourage another test of the $2,200 level for gold. So let's see what happens. All eyes are on the CPI, but until then, I'm done for today. I'm İpek Özkardeşke and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments and please do not forget to hit that like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow and until then, good day trading.